What caused Silicon Valley Bank's failure? Silicon Valley Bank was one of the most renowned banks in the tech industry. The bank's success story was quite fascinating until its failure in recent years. This video will explore the reasons behind the bank's failure. One of the most prominent lenders in the world of technology startups, struggling under the weight of ill-fated decisions and panicked customers, collapsed on Friday, forcing the federal government to step in. Silicon Valley Bank collapsed Friday morning after a stunning 48 hours, in which a bank run and a capital crisis led to the second-largest failure of a financial institution in U.S. history. California regulators closed down the tech lender and put it under the control of the U.S. Federal Deposit Insurance Corporation. The FDIC is acting as a receiver, which typically means it will liquidate the bank's assets to pay back its customers, including depositors and creditors. Silicon Valley Bank's downward spiral accelerated with incredible speed this week, but its troubles have been brewing for more than a year. Founded in 1983, the bank had long been a go-to lender for startups and their executives. Though the bank advertised itself as a partner for the innovation economy, some decidedly old-fashioned decisions led to this moment. Here is the sequence of events that led to Silicon Valley Bank's failure. Federal Reserve raises rates. The Federal Reserve has been raising interest rates from their record low levels since last year. In its bid to fight inflation, investors have less appetite for risk when the money available to them becomes expensive due to the higher rates. This weighed on technology startups, the primary clients of Silicon Valley Bank, because it made their investors more risk-averse. Flush with cash from high-flying startups that had raised a lot of money from venture capitalists, Silicon Valley Bank did what all banks do. It kept a fraction of the deposits on hand and invested the rest with the hope of earning a return. In particular, the bank put a large share of customer deposits into long-dated Treasury bonds and mortgage bonds, which promised modest, steady returns when interest rates were low. That had worked well for years. The bank's deposits doubled to $102 billion at the end of 2020 from $49 billion in 2018. 1 year later, in 2021, it had $189.2 billion in its coffers as startups and technology companies enjoyed heady profits during the pandemic. But it bought huge amounts of bonds just before the Federal Reserve began to raise interest rates a little more than a year ago, then failed to make provisions for the possibility that interest rates would rise very quickly. As rates rose, those holdings became less attractive because newer government bonds paid more in interest. That might not have mattered so long as the bank's clients didn't ask for their money back. But because the gusher of startup funding slowed at the same time as interest rates were rising, the bank's clients began to withdraw more of their money. To pay those redemption requests, Silicon Valley Bank sold off some of its investments. In its surprise disclosure on Wednesday, the bank admitted that it had lost nearly $2 billion when it was all but forced to sell some of its holdings. Banking regulators close SVB, move quickly to avert crisis. Some Silicon Valley Bank clients face cash crunch, as higher interest rates caused the market for initial public offerings to shut down for many startups and made private fundraising more costly. Some Silicon Valley Bank clients started pulling money out to meet their liquidity needs. This culminated in Silicon Valley Bank looking for ways this week to meet its customers' withdrawals. Silicon Valley Bank sells bond portfolio at a loss. To fund the redemptions, Silicon Valley Bank sold on Wednesday a $21 billion bond portfolio, consisting mostly of U.S. Treasuries. The portfolio was yielding at an average 1.79%. Far below the current 10-year Treasury yield of around 3.9%. This forced SVB to recognize a $1.8 billion loss, which it needed to fill through a capital raise. SVB announces stock sale. SVB announced on Thursday it would sell $2.25 billion in common equity and preferred convertible stock to fill its funding hole. Its shares ended trading on the day down 60%. As investors fretted that the deposit withdrawals may push it to raise even more capital. Stock sale collapses. Some SVB clients pulled their money from the bank on the advice of venture capital firms, such as Peter Thiel's Future Fund, Reuters reported. This spooked investors such as General Atlantic, that SVB had lined up for the stock sale, and the capital raising effort collapsed late on Thursday. SVB goes into receivership. SVB scrambled on Friday to find alternative funding, including through a sale of the company. Later in the day, however, the Federal Deposit Insurance Corporation, FDIC, then announced that SVB was shut down and placed under its receivership. The FDIC added that it would seek to sell SVB's assets, and that future dividend payments may be made to uninsured depositors. The Silicon Valley Bank's story is a cautionary tale for financial institutions and startups alike. Risk management and market research are crucial components for sustainable growth and long-term success. Thank you for watching. If you enjoyed this video, be sure to give it a thumbs up and subscribe to our channel for more exciting content.